Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Today we are focused mostly on dividend paying stocks. We are speaking with Laura Lau. She's the CIO of Brompton Funds, where she manages about $4 billion, and she looks for dividends around the world, and she gives us her best ideas as always. And if you want those best ideas straight to your mailbox, as well as daily insights into what is moving the markets, you can go to our website, inthemoneypod.com, and smash that subscribe button. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is brought to you by Raymond James. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors. They've got $88 billion in assets under management and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Now, whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Laura Lau, thank you so much for joining me today.
Thanks for having me, Amber.
You love something that our audience loves too, dividends. You look for dividends pretty much in every market condition. Is that right?
Yes, that's correct. I run a lot of dividend grower funds. Yes.
And Brompton's got $4 billion in assets, and you go anywhere in the world for that?
Yes, we do, except for emerging markets.
Now, let's talk about dividends in the context of today's markets, where, especially in North America, you've got these record highs. And as I said, the audience loves dividend paying stocks, but the market right now is chasing growth, chasing deals, chasing AI. So what do dividends and finding dividends look like in this kind of market?
So what we tend to do is follow very big macro trends. So for instance, AI is a big trend now. We're following this before and calling it intelligent automation, and now AI has consumed the market. And what we are also really investing in terms of AI is the AI infrastructure, because we're seeing that AI is just sucking up everything, whether it be electricity, chips, everything. So we had invested in that all along, and we're just seeing that every day new announcements are being made about AI infrastructure.
Now, the income that you can generate from that trend, do you have to make a trade-off and understand that maybe your appreciation is going to come from just stocks ripping higher versus relying on the income or the dividend that they spit out? Or are you adding a second layer? Yeah, you got to be an AI stock, but you also have to pay a dividend even if it's modest.
So it depends on the fund. So our technology fund, you don't need to have a dividend. But in our dividend growers fund, yes, you do have to have a dividend. So what we're also taking a look at is we consider it more total return. So it's not just the dividend. We do look at the capital appreciation, and then we also have a covered call component, and we use that to harvest some of that volatility, because some of these AI stocks can be very volatile, but we can use that to give you more return.
Does anything about what's going on in the market, particularly with AI, make you nervous? I think about the deal with AMD that was announced. AMD soared 30% because effectively they're giving their customer an ownership stake. That customer says, I'm going to buy stuff from you. You'll get an ownership stake. And part of that ownership stake gets lucrative. If our stock price does well, how does our stock price do well? You buy more of our chips. It's becoming a little bit circular with some of these deals.
Yeah, so we did see that also with another NVIDIA deal. So what we think is, if you take a step back, we truly believe AI will be like the internet, when everybody had the internet on their phone and on their computer. And this is really just the first innings. But, so long term, we do think that it'll work out. But of course, no road is ever smooth. There will be bumps in the road. And there are questions like, say, OpenAI, how are they going to fund this? So there's certainly questions about that. We're less concerned about Microsoft, Google, or Meta because they have so much money on the balance sheet. It won't be a problem. But OpenAI has to be a little more creative in order to get this funding. So that we'd be a lot more worried about than, say, if there's a deal with some of those big technology companies. Because, as I said, their balance sheets are so good, I'd rather have them as a counterparty than the U.S. government.
Oh, well, that's an option these days as U.S. government is becoming more involved in the stock market. One of the things, because we've seen the stock market rally so much, particularly in the U.S., is it barely offers a dividend yield as a broad market. Is it harder to find those yield opportunities?
It is harder, but as I said, we actually look at, the total return. So we also do look at capital gains. The other thing is we can also go to places outside of the U.S. So the Canadian market's been making all-time highs, so there's certainly opportunity there. And we also can go to Europe where the dividend yields are higher and the valuations are more attractive.
We should talk about Europe. It has, in certain areas, not all the European markets, but you've seen some massive outperformance. People might not know this, but European banks have actually done better than the Magnificent Seven, not just over the past year, even over the past 5 years. European Bank Index has done better than the Magnificent Seven. What's going on with the European re-rating?
So we've actually been overweight European banks because we've seen the end of zero or negative interest rates in Europe. So that was very, very tough on these European banks. And a lot of them were trading at substantial discounts to book value, like 0.3, 0.5 times book value. So you're getting a little bit of that lift simply because of valuation. And also the fundamentals have gotten better. And then we're also seeing that in Europe, they're starting to realize that they can't go on the way they have. So certainly with Germany, they realize they got to spend some money. So they are, loosening the purse strings. And Germany typically in the past has been the tightest on the purse strings.
Is there still value, even with the rally in European bank stocks?
We still think that there's value there because, as we said, the fundamentals are getting better. And most of them are still trading at a substantial discount to book value.
Let's pair them against the Canadian banks, which, you could throw a lot of negative things about what's going on in the Canadian economy, but the bank index is also trading at a record high. There hasn't been a lot of dividend increases so far this year. That I think that's expected to happen later this year. But how do you think about the Canadian bank's relative attractiveness?
So the way I think about it in Canada is the worst is over. What I mean by that is it looks like those loan losses have peaked. And if the loan losses have peaked, what will happen is they took charges against earnings and they'll start to release those charges and they'll actually start to have some excess capital. With that excess capital, you can start increasing dividends again. You can start, buying back shares again. But I would say that relatively, Canadians love to hate their banks, but, it's becoming, a better investment because also the past couple of years, it's been not the best investment. So they're starting to play a little catch up. But I'd say right now, I feel that, the European banks offer more upside.
Okay, well, you know what I love about you is you talk stock specific. So we are going to get into the mailbag right after this break. This is our mini-series on cross-border considerations with Raymond James, where we talk about things that Canadians need to know when you've got money or family on both sides of the border. And to do that, we've got Darren Coleman. He's Senior Portfolio Manager at Portage Wealth, part of Raymond James. Darren, thanks so much for being with us.
Thank you for having me.
So there's a lot of issues that come up when you've got these cross-border considerations. One of the most common issues I imagine that you deal with in your practice is somebody who's moving to Canada, either for the first time or they're Canadian that lived in the US and they're coming back. What are some of the issues that crop up?
Yeah, you're right. We do see that a lot. Either it's a Canadian who spent a chunk of their working career in the United States returning home, or someone who's moving up to Canada, either for a job opportunity or maybe for love. And what they discover when they get here is that while their phone may work in both countries, and we watch a lot of the same TV shows, they're very different legal, tax, compliance, and financial systems. And they often discover that things don't work as easily as they thought they would.
What are some of the first steps that you should take to help understand how best to navigate this situation?
Yeah, getting clarity on how difficult it is often the first thing. Usually when people come to us, they've already kind of discovered that this was harder than they expected. One of the things that tends to cause the greatest amount of challenge is the fact that financial institutions are generally only allowed to deal with people that are in the same jurisdiction. So if you've got your money in one country and you've moved to the other, you'll find it very hard to get someone to actually talk to you about what to do. And we very frequently see that when people do with their retirement accounts. So if it's someone who's worked in the United States and they're coming back to Canada, they may discover that when they tell their US financial institution to change their address on their IRA, for example, which is like a Canadian RSP, to a Canadian address, they'll discover they're going to get a letter at some point that says your account is frozen and you can maybe only do transactions to sell. They also may get a letter that says they're going to get a check, less taxes and penalties, because that financial institution doesn't want to deal with them any longer.
So then I guess it's really important to be with a financial institution that's recognized on both sides of the border.
Yeah, and very few do, actually. It makes sense because this is a big problem, but I would say for a relatively small number of people. So if you're a large financial institution, it's probably easier to just raise your fees on a credit card or a safety deposit box rather than getting into the complexities of having a full financial engine that works in both countries.
All right. Well, for more on what those complexities are and how to navigate them, you can go to portagewealth.com. Our first question in the mailbag is about Apple. And I think it's such a fascinating chat right now because Apple's sort of like, where is your AI plan? It's a holding of yours, and you say you like cashed up players when it comes to this environment. And Apple, even though it doesn't have, a real AI leg to stand on, is back at a record high. Doesn't even need it. How do you think about holding Apple?
So I think Apple does need an AI strategy, but they're not wed to one. What I mean by that is, like, let's be honest, Siri wasn't great. But what they can do is they can, say, use OpenAI for their phone. They can use something else for their calendar. So I think that's what's going to happen, is that they will use other players. And what we're starting to see is the models don't really make a big difference. And we think that that will become more of a commodity. And we think that the ones that will benefit, going future is the ones that can adopt AI. And we think Apple can do that. So they'll just use best in breed for everything.
Why do we hold Apple? Why would you buy it at these levels?
I would say certainly Apple's behind in the AI race, but that ecosystem they have you ever tried to switch from Apple to Android? It's very difficult.
That's true. And at this point, I feel like my generation has so many photos that to port it to another platform would just it's prohibitive. Okay, our second question is on the oil and gas sector, which is quickly becoming a favorite. Not just for energy investors, but also for dividends. And I'm curious how you think about that. This question is coming from Leon K24 on Instagram. Do you have a favorite oil and gas dividend stock now that balance sheets are better?
So over time, as you said, that oil and gas companies, they've seen the light, that they're not spending, money, just drilling things in the ground, and they're starting to give back dividends, share buybacks. So what I would say is, in terms of, pipelines, I really like pipelines and midstream because they get paid first. They get paid before the producer. So for that, we actually do like Enbridge, 5.4% dividend, and they're saying the right things. What I mean by that is the government's like, can you please build an oil pipeline? They're like, no, we have no plans. You have to guarantee this because we lost so much money the last time. We're not doing it. So I think that's good. And the other thing that people don't realize is Enbridge actually owns a lot of gas utilities. And that will benefit from the AI trade as well because we need gas to power these data centers.
Both Enbridge and TRAP, TC Energy, the former TransCanada, are at record highs. After maybe a little bit of sideways trading, you'd feel comfortable adding here? You still think that there's momentum to the upside on Enbridge, because I guess that's your favorite.
Yes, I do believe that there's still some upside there. The other thing is when the TMX pipeline came on, people were very concerned about diverting those volumes from the Enbridge mainline pipeline, and we're going to need both pipelines.
I'm curious if you've ever looked at a Pembina pipeline, which has about a 5% dividend yield. It's lagged. It's not at an all-time high, but there's some recent excitement that maybe they're going to announce a data center deal with Meta, and that got the stock popping. That's currently unconfirmed, though they are progressing on a possible project called the Greenlight Electricity Center. Do you think Pembina offers an opportunity both for capital appreciation and dividends?
Yes, I do. Pembina is also a well-run company. It's just that at this point, I prefer the Enbridge.
What about in producers, in the oil and gas producers? Any Canadian favorites?
So our favorite would be Imperial Oil. And part of the reason for that is we think oil will be range-bound now. Just one good rule of thumb is when OPEC bickers about quotas, there's too much oil in the world. So we do think that oil will be range bound in price. But with Imperial Oil, they're doing all the right things. Their operations have been improving. Their oil sands assets, the productivity is improving. The price per barrel break even is $35, below $35.
Yes, yeah.
So, you'll be good with Imperial Oil no matter what. And they're also giving you your money back in terms of giving you back the free cash flow in terms of dividends and share buybacks.
And it has outperformed in this environment. It's close to a record high. I mean, they just announced another round or a round of layoffs, which should, not great for people who are losing their jobs, but should improve, their cost structure. And as you said, they're already so low in terms of their break even. You must look at a name like CNQ as well, which I feel like is such a favorite of Bay Street, but it just doesn't perform. Why do you think that Imperial has had that leg up? Is CNQ a name that's interesting to you, Canadian Natural Resources?
So CNQ is a fantastic company, but it's well owned in the Canadian market. So in order to get that stock moving, I think you do need higher oil prices. You need US, you need global investors to buy it. So that's why I would prefer the Imperial Oil, because I don't need oil prices to go up for Imperial Oil to work.
We got a question actually on the parent company of Imperial. Imperial is largely owned by Exxon Mobil. And Simon on Instagram wants to know simply, is Exxon a hold or a sell?
So I would say, Exxon's another one like Imperial, very well run. And, it doesn't really matter so much but the oil price. I'd say Exxon's probably a hold. They are also going through that rationalization, reducing costs. Guyana is a fantastic asset. Production is usually better than expected. And, the project comes, faster than expected. The issue now is with new government Guyana, they'll try to negotiate new fiscal terms. They did get good fiscal terms with Guyana, and I think that could put some pressure on the stock.
I mean, it really has been flat. But on a valuation basis, I think we just had Rick Rule on the show, who he loves to traffic in these little small names. But one of his top ideas was Exxon, just because he's like, it's sitting there in plain sight and it's so dirt cheap.
Like if people want oil, it is the go-to name. And at some point, oil is cyclical, it will recover. And that's the first thing they tend to buy.
We've got a lot of questions about oil gas in the mailbag. Our second one is about Parex Resources. This has a nice yield, over 8%. It is in Colombia. It's definitely had a lot of missteps in the past, though the stock is up nicely so far in 2025. It's up 25%. And the question from Abhishek on Instagram is, what do you think about Parex Resources? Do you think they'll continue to offer that 8.5% dividend yield over the next 12 months? Have they cut it in the past? No.
No. So many, many years ago, I did go to Colombia to see Parex. So right now, Parex does not have to cut their dividend because they have cash on the balance sheet. And also, in terms of their capital program, the dividend's about 85% free cash flow at the current oil price. But the issue is their budget was done at a higher price. It was done at $75 Brent, not $65 Brent. So I think that they don't have to cut the dividend, but if they find a better use, like say an acquisition, or they want to spend more money drilling, then they could consider cutting the dividend, but they don't have to.
Would that make shareholders happy or unhappy?
No shareholder's ever happy when the dividend is cut.
Okay, our next question is on Dollarama. This question coming from LaFlamme123 on X. Can you comment on the valuation of Dollarama? The PE got as high as 45, but it's come down towards 40. Is it expensive, or is this a fair price for a company that keeps delivering great results?
So Dollarama is one of the great compounders in the Canadian market. So a lot of portfolio managers just blindly buy it. And, is it the valuation expensive? Yes, it is. There's no doubt about it, but they do keep on delivering. And for a while, when the multiple was lower, it was more like, oh, it doesn't look like they're going to open more stores. But now it's become more of a growth story again, because especially with Latin America. So Latin America, they're going from 650 stores to over 1,050 stores. And I think also there is an opportunity for the reject shop in Australia. I did visit them when I was there in Australia.
Look at you, guy. I know you were there for personal reasons. Look at you turning it, not avoiding business while you're on those trips. What did you think of the reject shop?
So it was more like a discount store. And I do think Dollarama can really, bring their brands over to their mix. And I think they could do very well there.
We have a question. I think in doing a dividend show, we knew that this question was going to come up, obviously about the telcos. I need a forecast on BCE. The balance sheet is looking better than before. What are the next steps? This one coming from Michael on Instagram. And BCE did cut their dividend. They had this very high yield, and they were overextended. They cut it. And now the yield, it's still not bad, 5.5%. But the stock, I don't know, it hasn't really re-rated materially.
So, the problem is when, a big dividend stock like this cuts the dividends, investors don't really forgive it. Like, look at Manulife. Manulife, it took a long time for investors to forgive Manulife cutting their dividend.
That was like more than a decade-long purgatory. You think that could happen with BCE?
It could happen with BCE as well. And, BCE is struggling, their debt load. It's improved, but it's still high. It's still higher than I would expect it. And then, they sell off MLSE. Everybody's excited. They're going to bring down the debt. And then they go and buy, fiber business in the U.S., which, to be honest, we don't understand what the synergies are, what the benefit is. And then you bring the debt back up to where it was before. The debt, like they are selling some other businesses, it's going to barely make a dent in that debt. So that's the problem. So the other thing is, well, then, can you grow your way out of the debt? It's tough without more immigration coming to Canada. We need population growth. The one light that is better is we've seen with back to school that the cell competition is not as bad as before. But I think that it's going to be tough for BC. They are cutting capital. That will help. But it could be tough for BCE.
Do you have any preference for any names in telcos, or is that a sector that you're avoiding?
Right now, we like Quebecor.
That's been the horse to pick. Do you continue to like it?
Yes, we continue to like Quebecor.
It's done very well, outperforming kind of all the others. And you get, let me look up the dividend yields here. A nice 3% dividend yield, nothing to shirk at. We got a lot of questions in the mailbag just about how to approach different ways of dividend investing. I think let's get into that now. There's preferred shares as a way for people to kind of get income. And Zervinos on Instagram asked, what are your thoughts on preferred shares for income dividend as part of your portfolio?
So in Canada, we tend to like preferred dividends, and certainly you get that dividend tax credit. So I do think that, there is a place in an income investor's portfolio for preferred shares, but you have to understand how they work. You're not going to get that upside that you would with the bank stock. And it's really priced off of 5-year Government of Canada. So in the heyday of preferred shares, when those shares got repriced at the end of the 5 years, there's typically a reset on top of it. So you get Bank of Canada 5-year, and then it was very low. The lowest was 1%. And as a result, the stock trades down. So you have to be very cognizant of that. So just full disclosure, Brompton, we have split share corps where we would have a preferred share and a capital Class A share. So that preferred share, we would reset it. And when we reset it, it's based on market rates, not this fixed margin over. And on top of that, if you don't like that rate, you can actually give it back to us. And that's a big difference where those corporates, you don't like the rate, you're stuck with it. And then you have to sell in the open market. These you can give back to us. And as a result, they trade very close to par value.
Okay, so that's the advantage. We actually did get a question because of your experience managing split share funds. How do you assess the long-term sustainability of a split corp's payout structure? And again, a split corp, as you said, is you have the preferred share and the Class A share. In particular, what metrics or safeguards distinguish a properly managed split corp from one that's gradually eroding the net asset value through excessive leverage or capital drawdown?
So I can't talk about all my competitors, but I can talk about Brompton. So the way we work is that, the preferred share is about, $10 net asset value. And then you have the Class A. And that, let's make it simple, $10. And then what you do is you invest in an underlying portfolio, and it can be banks, it can be life insurance companies. So for us, when you add those two, the net asset value together, if it's less than $15, we don't pay out the Class A dividend. And the reason we do that is to protect the preferred shares, and you also protect the Class A shareholders. And the dividend, the capital gains build it back. And this has gone through the financial crisis. So it's some of these we have, almost 20 years of long-term performance. So for instance, say the Lifeco one, which is LCS. In the financial crisis, there was no value for the Class A share, but I had some very smart.
And you didn't pay out.
And we did not pay out. And we had some very.
So that's something you have to know.
Yes.
Is you're not going to erode the value by forcing yourself to pay when it's not attractive to do that.
But the preferred share still got it. And I had some very smart hedge funds that realized this is great option value. So they paid, $1 for it. And when the market recovered, they made out like bandits. And today that is still working, and people have made a lot of money. You have to know when to buy the capital share and when to sell it.
So does that mean you should be, if you're evaluating these split share funds, like part of the question is how do you evaluate the sustainability of a payout structure? It might actually have to do with what are their terms on payment, right?
Yes.
Are they, I'm committed, I'm going to pay you every month or every quarter, whatever it is, that might actually not serve you in the long run.
Yeah, so really the devil are in the details. So you really have to understand the structure when you pay out, when you don't. And then also you have to think about sometimes the Class A trades at a premium or a discount to net asset value. So for instance, Split Bank Corp, SBC, that's our split one for the banks. Mm-hmm. It trades at approximately, I'd have to check today, maybe 8 to 10% discount. It's the only way you're going to buy Canadian banks at a discount.
And what happens when it trades at a premium?
Then it still trades at a premium. And you can choose to sell it or you can choose to keep it.
We got a question. There's so much innovation always in this space. What do you think about these new single stock covered call ETFs? Because they can really offer huge dividends. This one coming from Mark in Calgary, more than 10% for most of them. When you see something like that, it's as juicy as it looks, you have to ask, is it sustainable and what are the risks?
I think for these, you really have to do your homework. So first of all, single stock, that's definitely more risk. There's leverage, that's risk. And then a lot of them have a covered call component as well. So you have to really do your numbers, which to be honest, is not really easy for a retail investor. But what you got to do is think, say Canadian Natural. What is it paying? Can that stock actually give you that return? Because if it can't give you that return, chances are leverage and covered calls aren't going to give it to you either. And then with covered calls, the way it tends to work is it really depends on the volatility.
So is the right way to think about it, say I'm like super bullish on Canadian Natural Resources and I want to go all in. Is it a more bullish way to express a view, or is it a way to kind of hedge your possible downside? Because, if my bullish view doesn't manifest, at least I get this nice 10% yield.
So it's kind of strange because, when you write covered calls, what you're basically doing, it's like an insurance premium where they give you money up front. So that helps on your downside, but then you have less upside. Mm-hmm. So then what are you getting? And then you put leverage on top of it. So that's why it's kind of odd.
Like, I don't know what it's for.
Yes.
I guess is like, What are you expressing when you buy one of those things? Other than I like yield.
Yes. And it's basically a way to manufacture yield. But one thing to think about is, how much can you get from covered calls? It really depends on the volatility of the stock. So you can get more from NVIDIA than you would get from an Enbridge. And the volatility changes. So how much you're paid differs as well, depending on the market environment. So for instance, if the stock drops a lot, you can get paid more from your covered calls, which makes sense. But I'm not sure the math works. And you have to go through them one by one, because we don't have time to go through every single one, but you have to go through the math one by one. And, depending on the stock, you might be able to get 2 to 4% a year extra, maybe.
Yeah. If it
with the covered call,
with the covered call, yeah.
And then you have to think about the leverage, and then there's a cost for that leverage too, because you have to borrow for that. So there is a cost for that.
All right. That's good perspective. I feel that's helpful for our audience. Let's get into your highest conviction ideas. It's time for your pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Your first pro pick is Citi. And I feel like that's a name that was sort of in the doghouse for a long time, and certainly compared to what it was before the financial crisis, it's still not recovered. But it's had a very nice run in 2025. It's up 40%. Why is Citi one of your top U.S. banks to hold? So one big trend we do see is deregulation. And we do think that Citi will benefit from that. They are a global, systematically important bank. So we do think there's be some reform on that so that they don't have to hold so much capital. So when you think about it, since the great financial crisis, we've been asking banks, to have more regulation, more capital, and that's finally turning. So that's benefiting the banks. With less regulation, we see that they're letting go of 20,000 people. They'll be a big beneficiary of AI to automate processes, and capital markets are coming back. So they have about 30% of their revenues are connected to banking and markets. So we also see in terms of share buybacks, they have $16 billion of excess capital. So we believe that there'll be more share buybacks. It could be as high in the next 12 months as 10% of their capital. Now, why express your view through Citi, which, by the way, has been outperforming the S&P 500 bank index recently? People with longer term memories know that hasn't always been the case. But do you really think that it's at a turning point, that it's at an inflection point? I think it's past the inflection point. And I do think that, as I said, we've made a lot of money on Citi, and we think we will continue to. Okay, your next pick is Broadcom, which has actually done pretty well and recently has been outperforming NVIDIA. What do you like there? So what we like about Broadcom is that, they have two big businesses. One of them would be infrastructure software, and the other one would be chips. So the chips, they do custom chips, and they also do networking chips. And
you need them for all those data center builds. So we've seen their AI revenues increase more than 100% year over year. And a lot of these markets, they have very good pricing power because it's very necessary for these data centers, and they have high market share. So we think that it'll just continue to do well. And for those that like dividend growth, they've been growing their dividend 13% CAGR over the past 5 years. So this is a good, we think, balance of growth and income.
So that's interesting. And is that how you would stack it up against the likes of an NVIDIA, which I think is still the go-to name?
In our tech fund, we own that, but in our dividend funds, we think Broadcom makes more sense. It's lower valuation and it's got a higher dividend, and we still think that they're going to be one of the AI winners.
Have you mapped out the path? See, this is a cyclical business. And eventually this does end at some point, and people are trying to figure out, when that is. At Brompton, have you thought about mapping that out? Like, what does that look like? How do you know we're near the end?
So I'd say number one, that's partly why we have Broadcom, because almost half the business is software, high recurring revenues. So this way, we don't have to worry as much about the downside. So that's why we like it, especially for a dividend fund. And so far we see that there will be a point where, the AI CapEx will slow down. Hasn't slowed down yet, but we do think it's going to slow down at some point. And ironically, what stops it is actually electricity. It's not chips. Yes. And electricity, to get electricity takes a long time to get it, and the government's involved. The government has to approve it. So we think, if anything, that's what's going to slow it down. Not these tech giants, they want everything yesterday. But the government, they have to go through their due process. It's going to take a while to get a lot of the electricity needs.
Your other idea, your third one here, is from across the pond in London, BAE Systems. So you go global for your dividend stocks. BAE is one of them, also has had a tremendous year, trading near an all-time high. What's taken it there, and why do you think it can go further?
So one of the other big themes we see is that political risk is getting higher. And this is one way we're expressing that. The world, unfortunately, is becoming a less and less safe place, and we need to defend against that. And you see Donald Trump is going to his NATO allies, going to Japan and asking them all to spend their fair share on defense. So especially Europe, Canada. So Europe, last year they spent 2.1% of their GDP on defense. This year's 2.5%, and they're going to promise to get to 3.5%. Mm-hmm. So a European defense company will benefit more, we believe, than, say, a U.S. defense company. And they operate in air, which is about 55%, so that would be planes, missiles, water, navals, about 35%, so freighters, ships, and then 15% would be land, like tanks and such. So they have a nice diversified portfolio. They have, a lot of good customers, and they're getting new customers with, Trump's push for more defense. So we see this as a long-term trend. They've already increased their guidance for sales this year, and we think they're going to continue to do that with these tailwinds.
So, that really explains why it's done well up until this point. At what point does all of that become priced in? Do you think that's priced in right now, or there's still room?
We don't think it's priced in because we see these as very long-term trends, because you have to think that we've been underspending on the military for a long time. I used to work for the Canadian Air Force, and even then we didn't spend enough. So there's a lot of catch up to come.
What did you do for the Canadian Air Force?
So I worked in logistics, allocating, loading like Jeeps and stuff onto aircraft.
That's wild. Before being a fund manager.
Yes.
I guess that trains you to have a very analytical mind.
Yeah, I did that when I was in engineering.
That's so cool. Laura, thank you so much. Great chatting with you, and thanks for bringing these ideas to us.
Thank you.
That's Laura Lau of Brompton Funds joining us. Make sure you stay tuned to our next episode. We've got Josh Brown of Ritholtz Wealth joining us. He talks pretty much everything U.S. stocks. He's probably got a lot to say about the AI trade. If you want to know what Josh thinks about your favorite stocks, email us at questions@inthemoneypod.com. You can find us anywhere on social media @inthemoneypod. or you can visit our website, www.inthemoneypod.com. We'll see you on the next episode.